Hi, my name is Christian Waldegrave, Head of Research at Teekay, and this is our tanker market update for November 2023. Well, during our last video in September, we talked about how spot tanker rates had come off considerably through the course of Q3, and we said that this was due to two main reasons. Firstly, oil supply cuts in the OPEC Plus group, in particular Saudi Arabia and Russia, and also seasonal factors. However, we talked about how we expected these impacts to reverse during the course of Q4 and for an improvement in spot tanker rates. Now, thankfully, we were correct in that assessment, and spot tanker rates have improved significantly since the start of October, and in particular in the Aframax and Suezmax sectors. In fact, we've gone from Suezmax and Aframax rates of $20,000 a day or lower during September to in excess of $60,000 per day at present, and on some routes the rates are considerably higher. So what have been the main reasons behind this increase in spot tanker rates, and more importantly, will it last? Well, firstly, and as we said on our last call, the supply cuts that we saw from Saudi Arabia and Russia have started to reverse, despite the fact that both countries have pledged to keep their production cuts in place through the rest of the year. And that's because following the summer months, we've seen lower domestic demand for oil in both of those countries, and also the onset of seasonal refinery maintenance. So there's more oil available to export from both Saudi Arabia and Russia, and crude export volumes from those two countries are now on an upward trend and getting towards the highs that we saw in Q2. And the increase in Russian exports is particularly important for the Aframax and Suezmax sectors, given that around 90% of those volumes now flow long haul to China and India on Aframaxes and Suezmaxes. So that's a particularly big source of ton-mile demand for those sectors. We've also seen very high crude oil exports from other key Aframax and Suezmax load regions, most notably the US Gulf, West Africa, and from Brazil and Guyana in South America. In fact, Aframax and Suezmax exports from those three regions hit a record high of over 7 million barrels per day in October. So again, that's generating a lot of mid-sized tanker ton-mile demand. We could see another boost to ton-mile demand out of South America in the coming months due to the proposed lifting of US sanctions on Venezuela, which could lead to more Venezuelan barrels going on Aframaxes and Suezmaxes to the US in particular, also potentially to Europe on mainstream tonnage at the expense of volumes going to long haul to China on the dark fleet. So that could be another positive factor in the coming weeks and months. Finally, we talked in our last video about how refinery throughput was expected to pick up into the winter in order to meet peak winter season demand. And that's been the case as well. We've seen the IEA forecasting that crude refinery throughput will increase by about 2.4 million barrels per day from October to December. And so what we're seeing is charterers coming out and booking cargoes in anticipation of that strong winter demand, and that's added to a lot of chartering activity. What we've also seen is, the tragic events that have unfolded in the Middle East in recent weeks has potentially also added to some increase in chartering activity due to fears that conflict could spread and perhaps impact some of the oil production in the region. That hasn't been the case so far, but I think that kind of uncertainty is leading charterers to perhaps book cargoes early and try and make sure they have sufficient oil to meet that winter demand. So that's probably spurring a little bit of chartering activity as well. So all in all, when we look at all those factors combined, we think it's going to be a very positive winter market for spot tanker rates into Q4 and to Q1, particularly as we get deeper into winter and we really start to see those seasonal factors such as weather delays in key regions like the Turkish Straits and the Houston Ship Channel and things like that start to increase. Then we would expect to see more volatility in spot tanker rates. Now, moving into our outlook for next year, looking at the oil side, the IEA is forecasting a slowdown in oil demand growth to 0.9 million barrels per day next year compared to 2.3 million barrels per day in 2023. And that slower demand growth is due to a combination of a sluggish global economy, rising fuel efficiency, and probably most importantly, the end of the post-pandemic rebound effect. So This year was the last year that we just saw countries coming out of lockdown and getting back to their pre-pandemic levels of oil use. So we'll be a little bit more of a slower demand year next year for tankers. Not saying that demand will go down. We do think that tanker demand will grow, but perhaps not by the same rate that it grew at in the past 2 years. However, we do think that, on a ton-mile basis, the fleet will continue to get stretched, especially in the mid-sized sectors due to the ongoing war in Ukraine, meaning that all those Russian barrels are going long haul, and also due to supply growth in some of those key mid-sized regions, again, the US Gulf and South America, which will continue to support ton miles. However, the real story for next year and indeed the next 3 years is the fleet supply side. We continue to see that those fleet supply fundamentals are very positive. Looking at the tanker order book, it's still relatively small. The tanker order book is hovering at about 6% of the size of the existing tanker fleet, which is very low on a historic basis. And furthermore, the shipyards are very booked out now for the next 3 to 3.5 years. So we think that tanker order book is pretty much locked in through the end of 2016. And if you wanted to go order a large tanker from a shipyard now, you're probably looking at a first half 2017 delivery. So we have this small order book that's delivering over quite a long period of time, 3.5 years. And now we can't go and order a new tanker until 2017. So that gives us some certainty on the order book for the next 3 years or so. Furthermore, the fleet is aging. If we look at the Aframax and Suezmax sectors, about 11% of the fleet currently is 20 years or older, but another 14% of the fleet turns age 20 over the next 3 years, so between 2024 and 2026. So when you combine this very small order book with an aging fleet, and given the fact that the shipyards are quite full because they've been taking so many orders for non-tanker ship types such as container ships and LNG carriers, then you've got a very good fleet supply outlook. And our fleet supply model, which uses the current order book and assumes a very conservative level of tanker scrapping, we think that tanker fleet growth will be less than 1% in 2024 and 2025, and potentially negative in 2026. So even if the demand growth is a bit slower than we've seen in the past couple of years, the fact that fleet growth is virtually zero means that we should continue to see very strong tanker fleet utilization and very good tanker rates, not just in the near term through this winter, as we've talked about in the video, but really over the next 2 to 3 years. So that's our update on the tanker market for November, and we'll speak to you again next month.